Members, good afternoon. It's 4:30, so I now call to order the meeting of the Subcommittee on Banking Capital Amendment Rules 2017, Banking Liquidity Amendment Rules 2017, and Banking Specification of Multilateral Development Bank Amendment Notice 2017. Let's proceed to the election of chairman. Mr. Chen Chen-ying is nominated. Who seconds that? Mr. Yu Si-wing is the seconder. Mr. Chen, do you accept the nomination? Yes. Do we have another nomination?
Okay.
No? On the count of three. 1, 2, 3. I declare Mr. Chan elected chairman.
好，咁我哋而家就請政府官員入嚟啦。
All right, please invite the officials to join us.
用效率啲要，因為跟住要，唔係啊，要我哋去食飯啊，我哋今日。呢個。啲政府官員冇準時喺外邊等啊
！Aren't the officials waiting outside? From the administration, we have Ms. Erica Zhang, Principal Assistant Secretary, Mr. Darrell Ho, the Executive Director, Banking Policy, Hong Kong Monetary Authority, and also Mr. Richard Chu from Hong Kong MA. There are a number of other officials, and I will introduce them one by one. So over to the administration for a brief introduction of the three pieces of subsidiary legislation. Thank you for inviting us to this meeting. I want to give you a briefing on the three pieces of subsidiary legislation in relation to the implementation of Basel III related standards. And they are Banking Capital Amendment Rules 2017, Banking Liquidity Amendment Rules 2017, and Banking Specification of Multilateral Development Bank Amendment Notice 2017. I'll be giving some introductory remarks, and I'll defer to my colleagues from the Hong Kong MA for detailed introductions. First, the Banking Capital Amendment Rules 2017 is to introduce three revised sets of capital standards as promulgated by the Basel Committee on banking supervision, covering regulatory treatment of an authorized institution, securitization exposures, leverage ratios, and expected loss provisions. The second one is the Banking Liquidity Amendment Bill 2017, which is to introduce requirement for an authorized institution to maintain a net stable funding ratio or core funding ratio as applicable to ensure that it has sufficient funds to support its lending and to reduce risk. The third one is the Banking Specification of Multilateral Development Bank Amendment Notice 2017 to update the list of multilateral development banks within the meaning of the banking ordinance, so that AIs in calculating the capital requirement and the liquidity ratio, the risk shouldered in relation to multilateral development banks will be given preferential treatment. And we also want to cover certain multilateral development banks in the list. All these are to make ourselves align with international standards as promulgated by the Basel Committee. As a member of the committee, as an international financial center, we are duty-bound to adopt such standards to ensure the stable development of the banking sector and to protect the interests of investors. And while in doing so, the Hong Kong MA has consulted the banks and the associations of banks, and we hope that we can follow the international timetable, and the 3 pieces of legislation can come into effect in Hong Kong on the 1st of January 2018. Do we need some further elaboration from MA, or shall we ask questions right away? How many members would like to raise questions? Mr. James Toh. Chairman, let's say 5 minutes for each member. Okay? To play safe, perhaps you should declare your interest first. I don't know whether your bank will be affected. Thank you for your reminder. Well, I work in a bank, and I represent the banking sector. Of course, the relevant rules and notice would affect my constituents. I want to say something about paragraph 6 of the electrical brief. This is about banks' securitization exposures. Can you tell us what's the difference before and after the introduction of the new regime? Who will take this question, Mr. Ho? Let's talk about some guiding principles, and then I'll ask my colleague to elaborate on the technical details. The guiding principle is that when the bank's participation in securitization transactions, some of the capital requirement will be based on the rating of certain rating agencies in the calculation of capital requirement. When this is applied to securitization transaction, the calculation is not sensitive enough. And now under Basel III, some supplement will be required instead of mechanically relying on the rating agencies' ratings. Under Basel III, that is the new regime, it will be more sensitive to the actual risk level. So that's the spirit behind the regulations. But we can also quote some example to illustrate some technical issues to illustrate. I'll defer to my colleague, Mr. Chu. Yes, as Mr. Ho has told you, under the old framework, the weighting of the risk is basically based on the rating of a relevant rating agency. But such are external ratings under the new framework. We would look at the underlying exposure.
我個資產裏邊分係基礎嗰個
That is the underlying risk. And the AI has to rate the risk in some way. If this is done under an internal rating approach, then under the new regime, there will be a corresponding way of calculating the exposure so as to reduce the rates. So this is to ensure that there is a higher level of sensitivity to banks' securitization exposures. So Mr. To is asking that you would rely on internal rating or assessment. But is this a relationship of and? Are the two parts required at the same time, or is it a relationship of all?
真係一間即係用內部評級嘅內部評級風險權重方法嘅銀行咧。
Banks using the internal assessment approach. If the securitization exposure has been rated externally, then you have to use the external rating. But if it's not externally rated, you have to use an internal rating. Under the new regime, although it may be externally rated, I think we're talking about IRB. If there's an IRB, if you don't have IRB, you have to use the standardized approach. I would like the MA to elaborate. There are two approaches, IRB or standard rating, IRB or standard rating. If it's been externally rated, then the securitization product must be assessed on that basis. But now the new regime allows a flexibility. That is, if it's not externally rated, then you can use an internal rating approach. I'll queue up again. I'll queue up for the next round. Mr. Chen Kim Paul. Let me declare my interest. I'm an independent non-executive director of the Bank of East Asia. It's said that you have consulted the Hong Kong Association of Banks. Have you accepted all their representations? Have you rejected any of their suggestions or views, if any? And you're going to increase the capital requirement. Do you allow the banks some transitional period? Who will take this question? Let me try to respond to Mr. Chan's question. First, with regard to the Hong Kong Association of Banks, we have consulted the industry in two rounds. First, on the principles and the need to have the new regulations, and secondly, we also consult them over the exact wording of the provisions. The industry supports that there's a need to enact the new regulations because this is about implementing Basel III related standards in Hong Kong, and they agree that it's beneficial to the stability of the banking industry. While they support this, they are concerned about the timetable of implementation and also how the technical provisions are to be interpreted in the actual implementation. And we have actually responded to their questions during those consultation sessions. They are generally in support of the wording adopted for the rules. As regards whether implementing the three pieces of new legislation would affect the capital requirement, yes, there will be some impact, but it will be minimum, because it's been some time already since the Basel III standards were announced, and the industry has already got sufficient time to make preparation.
So if you look at the authorized institutes, their risk commitment, it might only make up some 0.2% of the total risk commitment. So our requirements has been made specific, and in fact it has a minimal impact on them. And we don't see that how this change would affect their attitude to risk control. For example, if you look at the leverage ratio, that's an interim arrangement. In December 2013, we had required the AIs to make a report, and there is a specific format for the report. So we see that all the AIs comply with our requirement, that is not lower than 3%. So regarding other liquidity ratio requirements, recently in our survey, the industry can comply with this requirement. So we don't see, so after we strengthen these three requirements, how we will lead to undue pressure, and how it will make it difficult for them to comply. So the date of 1st of January 2018, this is the internationally agreed timetable. So if we look at our neighboring economies such as Australia, Singapore, they are also adhering to this schedule, and the industry have not indicated difficulty. Any other questions? Mr. Gai Chang? Paragraph 13 in the English version, banking specification of Multilateral Development Bank. The Hong Kong MA can specify some MDBs, or Multilateral Development Bank. So if we have a sovereign country development bank, it's not 2 or 3 countries consortium. Will that qualify as an MDB? Ms. Stone? Clause 2, bracket 19 in the banking ordinance, they have already defined multilateral development bank. So our definition is in line with the Basel international definition. So basically, if we have 2 or more countries, territories, or international organizations where they have established by agreement or guarantee other than for purely commercial purposes, these can be designated as MDBs. So when we designate this as an MDB, we comply with Basel requirement. So the International Development Association, Basel has already designated that as an MDB. So in line with the latest Basel notice, we have made this amendment. So when you specify the MDBs, do you conduct a test, or do you comply with the Basel committee? We comply with Basel. You cannot make any decision. We will not add new banks, because when we designate an MDB, the purpose is when the AIs have transactions with them, they can be given preferential risk treatment, and when we execute that, we have to be very careful. So we have to comply with international designations. We have to identify these MDBs. So this list of MDBs, is it static or dynamic? It is regularly updated. We added the IDA. It's actually, they're a member of the World Bank, and they added that bank, and therefore we made a consequential amendment. So the IDA, is that AIB, is it on the list? I'd like to ask if an institute is included in your list as a multilateral development bank. So is it an overseas financial institution? Because if you refer to the banking ordinance, you call it an authorized institution. The reason I ask this is it's related to interest deduction. A lot of banks, I'm not sure if the chairman is aware, a lot of banks discuss this issue with me and say a lot of times that they have financing projects and if the financing party is an overseas development bank, so whether it's a sovereign bank or an MDB, it's possible they cannot get the interest deduction because under the banking ordinance, the definition of authorized institution refers to institutions that conduct banking business, and they exclude development banks. So if you have such a list, will the development banks, will they become overseas recognized authorized institutions in the banking ordinance? I'd like to ask that question. We need the MAA to answer that. Mr. Chu, the AIs under the banking ordinance, they are not talking about sovereign institutions guaranteed by 2 or more countries. So overseas regulated banks or Hong Kong regulated banks. So a development bank is not an overseas authorized institution. No. But the banking ordinance aims to regulate the financing and disclosure requirements. So regarding the AI, we already have a definition. And within that definition, they are just talking about a commercial bank. We're not talking about the multilateral development banks. So, Chairman, I have raised a larger commercial issue. I declare that a banking industry representative had asked that question, Mr. Yu Siwei. Thank you, Chairman. Looking at the financial risk of Category 1 institutions, they have to maintain 100%, and for Category 2, they have to bear 75%. So other institutes that wish to come to Hong Kong to start a bank, will it lead to more restrictions? And if we have restrictions, then other jurisdictions, will they comply with Basel? And if they don't, does that mean our ability to track other banks to set up in Hong Kong, will that be an obstacle? Will that hinder our development as a financial center? And second, we already have a lot of local companies that might want to upgrade to become banks. So in that upgrade process, will these measures become obstacles? Thank you, Mr. Yu, for the question. Actually, regarding the liquidity, we have the available stable funding and the required stable funding. All these are the Basel III requirements. So the major economies and international financial centers will have to comply with that. So the different jurisdictions, when they comply, we believe that when Hong Kong implements the stable funding ratio and the core funding ratio, we will not this will not be an obstacle for them to set up branch offices in Hong Kong. So if you look at all the AIs in Hong Kong, when they comply with these requirements, there is no difficulty. So we don't see any other banks finding difficulties. So we have two indices, and in Category 1 institutions, we're talking about very active institutes where they have a lot of debt and they issue a lot of debt. We're talking about 250 billion Hong Kong dollar banks, and these we recognize them globally that they bear a high risk. So we do have a higher liquidity ratio required of them, and for Category 2 institutions, we're talking about for Category 2A institutions, they are not so active globally, but they do have significant influence in the local market. For example, retail banks, they play a role in the local stability. So for Category 2A institutions, we require them to comply with simple CFR requirements, the core funding ratio. So whether it's overseas branches in Hong Kong or local AIs, we don't see what kind of difficulties they will encounter when they comply with this. So regionally, are there any jurisdictions that don't comply with Basel? Essentially, jurisdictions in the region have to comply. For example, Australia, Singapore, on 1st of January 2018, they will implement this. Regarding the leverage, Europe, North America, and even China have already implemented the leverage ratios earlier than us. Basel III is unique in that, based on the previous global crises and financial instability, they have strengthened Basel II and to deal with the aftermath of financial crises. So we see that in our neighboring jurisdictions, they are very proactive in implementing Basel III because they need to safeguard investor interests. What about branch offices? Their headquarters are not in Hong Kong. How do you deal with that? So overseas banks, if they have a Hong Kong branch, we require them to meet the same requirements. If their local assets are less than 20 billion, we require the assets. If it's above 20 billion, we require them to meet the CFR. For branch offices, the requirement is even higher. If their assets is 100 billion or above, they have to comply with the relevant requirements. Anything to add? The second round, Mr. To. Let me follow up on that, on Mr. Yu's question. I want to clarify. Basel III within our competitors, Singapore, Australia, are there other countries that don't comply, or are there countries that will comply at a later date? We don't see any countries saying they won't comply or they want to postpone the implementation date, because internationally they've all agreed that 1st of January 2018 will be the implementation date. Can we put it this way? Your understanding is everybody is complying within the region. Just now you said that the major economies are complying. So does that mean smaller economies are not complying? MA? Thank you, Chairman. Well, first of all, a member of the Basel Committee, they have to comply with the Basel rules. One point you need to note is that the Basel Committee capital requirements or liquidity, risk management principles, these are all applicable to all globally active banks. So what are the principles? Well, if it's globally active, if you imagine a country where they don't have any globally active banks, you can imagine, then they don't need to comply with Basel III. But we have not examined each country. As far as we know, all countries that have globally active banks, they are complying with Basel III. And the Basel Committee the intention was to avoid discrepancies amongst jurisdictions. So all the Basel Committee member countries were complying. Well, let me clarify. I'm not going to ask about North Korea. I don't think that they have any global importance except for money laundering, perhaps. So my understanding is South Korea is compliant. What about Taiwan?
Mr. Hu, Taiwan is not a member of the Basel Committee on Banking Supervision. Do they selectively implement some of the Basel related standards, or we have to check? All right, to follow up the point made by Mr. Yu. For non-complying jurisdictions, are we going to treat them differently in any transaction with them? Hong Kong banks are regulated by Basel standards, and in calculating the exposure to non-Basel compliant banks, are we going to offer a discount if we hold certain assets? I don't know how the Basel Committee enforce the rules. But some countries cannot be coerced. They may just opt to do less business, or they may opt not to be active globally. All right, this is important. If I implement the rules on the 1st of January 2018, and if we cannot implement these rules by the 1st of January, are we going to be penalized? Well, we're talking about some favorable treatment in the calculation of exposure risk. For example, the Multilateral Development Bank specify in the notice, or public organizations concerned. But the preferential treatment is not based on whether the other jurisdiction is a member of Basel Committee or not. We look at the financial stability and whether investors' interests are properly protected. So these jurisdictions implement the Basel Committee standards to protect their interests. So there's no need to for the Basel Committee to offer some incentives so to attract these jurisdictions to implement Basel-related standards. If the banks are active globally, particularly if you are a financial center, then there's all the more pressing need to implement the Basel standards. I want to follow up a question on behalf of Mr. To. If a regional bank in Taiwan, which has not done things according to Basel standards, would an external rating agency adjust the rating of that bank, so that when other banks deal with this particular bank, there will be a higher capital requirement? We cannot speak on behalf of international rating agencies on how they do their rating, and whether in so doing they would look into whether the bank has complied with Basel II or III related standards. But generally, risk rating and assessment would look at a number of factors: capital adequacy, liquidity, and whether certain standards are met, minimum standards are met, we can imagine that in a particular jurisdiction, if the banks have not implemented Basel, the related standards, but they have a high level of capital adequacy, then the rating will be assessed accordingly. If the counterparty of one of our banks is a non-Basel compliant bank, then this bank of ours does not have to be bothered. They will just look at whether the securitization or the loan exposure is calculated under the standard approach, under certain rules based on Basel standards, and also whether the risk is calculated according to some Basel-based model, whether there's any default, any history of default, and other financial indicators will be taken into account in assessing the risk. So under this framework, and in answering Mr. Toe's question, there's no need to ascertain whether the other party, the other bank, as your counterparty, has implemented Basel-related standards. Well, Chairman, this is a very good question. Annually, we have international agencies coming to Hong Kong to do assessment, for example, INF, and they would go to different economies to do the same. They would look at the soundness of the banking or financial sector. And one of the indicators they would look at would be the implementation of Basel standards. And this is an important indicator to them. The relevant assessment results will be announced, and it will be known all over the world. So this would affect our banking industry to a great extent. Mr. Kenneth Leung? Mr. Toe, you can wait for the next term. For this capital amendment rules and liquidity amendment rules, I would like to know the actual way they are implemented. Are you talking about fully licensed banks that would have to comply with the new rules? And in calculating the capital requirements and liquidity amendments, are you saying that the standard will have to be complied all the time? Or are you going to take a snapshot every month? Or is it that the liquidity requirements and and capital requirements and liquidity requirements have to be complied with at all times? On the question of capital adequacy and liquidity requirements, not just licensed banks have to comply with them. Restricted licensed banks and deposit-taking companies have to comply with them as well. If they are locally incorporated, they will have to comply with the capital requirements. For the liquidity rules, there are chances that they have to all different banks, all the banks, different banks have to comply. In practice, they will have to submit quarterly returns in a specified form, so that we know whether they are in compliance or not. Ms. Hui, you may wish to supplement. Mr. Chu has talked about the capital requirement rules. For liquidity rules, we don't make a distinction according to the three categories. We look at the the size of capital and whether they are globally active. For globally active banks or the bigger banks, they would be called Category 1. Then they have to comply with NSFR. At present, they have to comply with LCR requirements. For locally important and which are not as big as Category 1, they will be called Category A, 2A, and they have to comply with a CFR. For NSFR, according to Basel standards, they have to comply with the 100% threshold all the time. As for CFR, we look at the scale of the banking operations. And for this, we would look at the monthly average. The first year is 50%, and then it will be 75%. Are you talking about liquidity? Okay. Mr. Chi was talking about the capital requirements. Ms. Hui, liquidity rules. Well, I understand that. I know banks will not experience major changes in terms of liquidity every few months. But for liquidity, how do you monitor? Do you have a real-time reporting system? Whether you are talking about the reporting system for the capital rules, do you rely on banks to report to you? And or whether you can have some testing functions in your monitoring system, or you want the auditors to report to you certain matters, or are you going to conduct checks? How are you going to monitor the compliance? Every year, a bank will have to engage an auditor to check the report to be submitted. The internal auditor will check their records to verify the report to be submitted. And then there's the need to engage an external auditor to check their internal control system, whether the internal control system enables the bank to submit accurate returns. So there is the external verification to ensure the accuracy of returns. And of course, we have regular on-site supervision. We send our people out to do some auditing. The scope may be different every time, but we will cover the data provided, and if we have questions, we can take a sample test to verify the correctness of the data submitted to Hong Kong MA. Mr. James Toh, there are 2 points under paragraph 6. You have a new calculation so as to reduce the mechanical reliance on the calculation. I think Basel III is about the bigger trend of tightening things up. I think you may have certain worries in respect of certain matters. You want to reduce the over-reliance on mechanical calculation. So there will be internal work and external work to ensure this. If the external assessment and the internal assessment come up with a higher risk, with different risk levels, you're going to require that a higher risk be adopted under the internal ratings on the if they use an internal approach, there is no choice. They have to use the assessment of their internal methodology. If an agency, outside agency, thinks that it's of a higher risk, but the internal rating says otherwise, you allow them to adopt internal ratings. Is it not going against the Basel's requirement and the spirit of the regime that we should tighten things up?
So perhaps you need to explain the internal risk-based assessment. Well, it's not an extreme modeling where they use a very lax standards. We do have to audit the bank's practice according to the Basel standards. So it has to be approved, then we will allow them to use it. So let me elaborate. So which banks can use the IRB approach? First of all, they have to design a model, they have to input some numerical data, it has to be verified, and we need to have an external consultant to assess this IRB, and that report has to be submitted to the regulatory regime. Then the bank can use the IRB. And the standards in the IRB, they have to be very stringent, and these have to be applied on a regular basis. So I think MA can confirm this. Why do they have this amendment? When the Lehman incident occurred, they might have some credit enhancement mechanism or tools, and they took a high risk, they might be a high risk item, and they would get a AAA rating. So in this securitization framework, if you use a different method to assess them, and they have a high risk, so Basel says that they want to plug this loophole. They don't want you to rely on just one credit rating to determine the composition of your securitization, and you can get a high credit rating and sell it to your retail customers. So they require you to use a mandatory IRB model, and it cannot be determined by the bank itself. There are some predetermined criteria, and you have to base your assessment on these criteria. They feel that Basel feels that that approach is more reasonable and fair. So that's why I asked the MA to confirm whether it was an and/or approach. You cannot choose whichever is handy. So I don't know if that answers your question. Well, I'll give you an example. During the Lehman incident, I understand they could get a good external rating through certain means, but when certain banks undertake this approach, our select committee is an open meeting, and the CEOs that were not involved, they said that they didn't understand that. They were not involved in the Lehman instruments, and they were not familiar with them. But the ones selling it, they said that we have an external assessment. Well, you say that the banks have to build a model, and it has to be approved, and then the Hong Kong MA is responsible because they were the ones who approved the model. So do we have some instruments that are so complex or innovative you cannot even rate them? So that's why external agencies can give them a high rating and nobody dares challenge them. So we might have a new product, a very toxic product, and the external auditors might approve it, and your in IRB might be at a loss to evaluate them, and you would assume that it's of zero value. Is that your approach? So Chairman, you are correct. I would like to use this example. Ms. Jung, I can respond, and then MA can elaborate. Well, Chairman's explanation was very clear, and we can confirm that the Chairman is correct. Mr. To's concern is understood, and that is Basel's concern as well. That's why we have Basel III, and we have this new securitization framework. It is to deal with the loopholes that are exposed by the Lehman incident. So, in Basel III securitization framework, they are not just looking at one item, they are looking at a basket of items, including the credit rating, or the different risks assessment, its capacity, and even the seniority and maturity of a securitization tranche. That's included in the formula. So each AI, they don't have much room to maneuver, because in Basel III there is the calculation methodology for securitization tranche. It's spelt out, and even each technical term, the definitions are all spelt out, and that's why we have a thick set of regulations, because there are a lot of calculations and formulas that are attached to each requirement. So in our subsidiary legislation, we are complying with Basel III. We use the formula calculation. We use all the criteria that are required by Basel. Well, to use the Chairman's example, the external assessment, but in the IBR, the model, it's not in your subsidiary legislation. It's not in this edition of the subsidiary legislation. So will the MA amend the IBR approach as well? Well, first of all, the Banking Capital Amendment tries to deal with the banks when they have securitization transactions. They have to calculate the capital requirements. So it's not related to the investment product. But I understand there are a lot of technical details we cannot illustrate in a few sentences. Now, Eureka gave us an explanation that when the banks calculate the risk-weighted capital requirement, we cannot just make reference to the IBR or the external credit rating. There are a basket of other factors that we need to consider, and this would include, in a securitization transaction, the risk is divided into different levels. So when there's a default or a loss, who has to bear the loss? There are different requirements according to the legislation. So when the bank calculates the capital requirements, they cannot just look at the nominal value and say what the credit rating is for that portfolio. So you have to look at each level, and you have to look at the seniority and maturity of the securitization tranche and calculate the associated risk weight, and subsequently calculate the capital requirement. So, put simply, what are the other risk factors? We have to look at the securitization tranche and how the different risk weights are applied, and calculate the risk weight based on the Basel requirements. Well, let's put it in a different way. Just now Mr. Darrell Ho said that, so no matter how innovative or complex your product is, you can calculate it based on seniority and maturity. It won't be so complex as to not get an outcome. Let me give you an example. We have re-securitization. It's not just we have securitization on 2 or 3 occasions. So we have 4 different methods, and each the banks can use the different methods, and the information requirement, and the chairman said that if you use the IRB method, the requirement is even greater. So you can use the IRB, but if you cannot comply in certain criteria, then you'll have to use the second method, and the risk weight becomes even more conservative. That is, the IRB is not as advanced, and in the second method, the risk weight might be even higher. And if that does not do the job, we have to use the third method, and the risk weight calculated might be even higher. So, as Mr. To said, if it's so complex as to it being incomprehensible, then in the fourth method, we can calculate it up to 1,250%. It almost have to be written off. So you'll have to use 12.5 times of capital to complete the transaction. So if you implement the amendment in paragraph 6, where you use the IRB, does that necessarily lead to that the reference made to external methods will it be more stringent than the external assessment? I'd like you to be careful in your response, even if you're about to retire, because some measures have been implemented, we draw the line, and we're now making it things tougher. But I've heard, so I have some concerns, I have some reservations, because will there be certain cases where the external assessment, all of a sudden the credit agencies get chicken, and they might be afraid of lawsuits, they might be afraid of going bankrupt, and your IRB model, you might not be able to catch up with the times, and the credit agencies, they might get cold feet and say they don't want to do it, and your internal model might be more relaxed. And touch wood, then people will say, "Whoa, what's happening?" Even the external assessors say it's very dangerous, and you're saying there's no problem. So, will we have a ridiculous scenario like that occur? I have to assume that our assumption is that the external assessors are more relaxed. Well, of course, there's a cost to all that. You do less business and so on. But I'm not sure if is it set in stone? It's either Basel or non-Basel. And if you say that we're more stringent than Basel, then we're driving business away. So I'm not sure if the whole Basel idea is that you'll have to use your IRB model. You cannot use external assessment, and we have to stick to that suggestion.
Mr. Ho? Maybe you have to repeat an important concept here. Whether a bank can rely on internal model to assess the risk of exposure. They have to satisfy some very stringent conditions before they can do this. So I cannot imagine that a bank can at will adopt some assess some risk assessment model so as to get favorable outcomes. Well, I'm not saying that it's very generous, but I'm saying that out of no reason, the external rating agencies becomes very strict, and now you pass the internal assessment model, and then when something happened, people would ask why. The more stringent external assessment approach was not adopted, and we are not moving forward as quickly as we should in relying on internal approach. So if for a product, then if suddenly the external rating has dropped significantly in respect of that product, would there be a trickling mechanism within the Basel III framework that you can, or perhaps there should be something to link up the internal model with the external assessment? I'll deal with some of the conceptual issues, and then whether there are certain thresholds which would trigger certain things, I'll defer to my colleagues. Can we compare the ratings assessed by an external agency and the internal rating? I don't think the two can be compared. We're talking about the underlying credit risk. But the risk shouldered by the bank is not at the very lower rank. They just only have to calculate the risk exposure where they stand in terms of the credit, the risk rating. We're talking about two different things here. The two ratings cannot be compared. The other ratings would take into account other factors, and that is your position in the securitization process, and how thick the layer is, and also I have to look at the priority, the seniority. If the other tier is very thin, and that is the risk cannot be absorbed, and very soon I will have to shoulder some loss. For the internal approach, if there's a big volatility in the market, and the external agency has significantly lower the underlying risk, should the bank respond? Well, in the real commercial world, the bank should respond and will respond. In the supervisory process, what are we going to do? I'll ask my colleague to see if they want to supplement. So I believe there is a general requirement of this nature. Perhaps we can have some supplement to what Mr. Ho has said. Ms. Hui, although the Basel Committee does not say that IRB model rating should be made with reference to external ratings. But the banks would generally look at all the risk events, including whether the downgrading by an external rating agency. They will monitor the news, whether there's anything that would affect the exposure. This is something the banks would do in assessing the credit risk. If a number of rating agencies have downgraded the securities exposure, I just cannot imagine the banks will not do the same. I know you talk about a general case and the commercial world, but I'm talking about whether it's in compliance with the rules. If they are not in compliance with the rules, you can press charges, but you're talking about the general practice. Well, actually, we want them to manage risk prudently. Well, then you have to argue with them whether it's prudent or not, because you don't want to rely. We want the banks to mechanically rely on that. Of course, your voice is louder, and they may argue you whether it's a mechanical reliance or just reliance. But if you and the banks and cannot agree, they may also lodge a judicial review application. And sometimes the external approach is different as a model. Or maybe I can give you an example. It's just as a reminder. If they think that Hong Kong is no good, the sovereign rating should follow that of China. And the FS has rebutted that. It's a mechanical reliance on certain sector. Some banks are doing business in Hong Kong. Some are national banks. But such as the chairman's bank. But if there's a downgrading by an external rating agency, would the banks follow suit? Sometimes they may have other factors to consider. So there is uncertainty. And then there's also the public perception. If nothing untoward happens, then it's okay, and we have a coverage, protection, insurance coverage of $500,000 per account. But I do smell some uncertainties under the new regime. Of course, you do this in accordance with a Hong Kong-oriented, locally based approach. But what if there's a difference between the external assessment and the internal one? Of course, if we have to follow the Basel standards, and there's still some gray area. We have to follow relevant rules on money laundering, for example. But this one, is this one the only way to comply with the Basel standards? We cannot be more generous than Basel requirements. But what about stricter? Are we being stricter than the Basel Committee? And of course, if we know that, that doesn't mean that we'll say no. We may still support the proposed rules, even though they are stricter than Basel requirements. I thank Mr. To for his comments. I think Mr. To has pointed out exactly the problems with mechanical reliance. This Basel III framework is about addressing problems based on mechanical reliance by external credit ratings. If say it's a AAA, and we do not look at the exposure, and then we make assessment based on the external ratings. But this time, apart from the external rating, credit ratings, we also look at the exposure, the distribution, the grading, the weighting of the securitization transactions. We follow Basel III faithfully. And nothing more, nothing less. Yes, nothing more, nothing less. We exactly follow the Basel framework exactly. So we would have a basket of factors to take on board, and we would look at each and every factor in detail, so as not to let subjective views coming in the way. So in the whole process is going to be stricter in the future. The banks cannot say that, well, this particular bank has very high ratings traditionally. They cannot say this anymore. Going back to the question raised by the chairman, how do we ensure the implementation by the banks? Apart from the bank's own rating, there's an external audit process. And banks are afraid of Hong Kong MA because from time to time they send people to the banks to check for compliance. And they can also ask for documents and papers to verify various things. If the external ratings have dropped and the bank still insists on the assessment internally, then they will ask questions. We're not doing more or less than what is required under Basel III. We want to make sure that risks remain within the controllable region. Mr. Kenneth Leung, securitization products, according to my understanding, will only involve institutional participants. I don't think there's much involvement of retail investors. But of course, the bank's risk will be affected if it is involved with a lot of securitization products. Am I correct in this understanding? Mr. Ho, yeah, this is a market for professional investors. The bank would deal with professional investors in relation to these products. But I cannot rule out that certain securitization products can be packaged as some investment products. But they are also subject to the oversight of SFC. And SFC would ensure that no retail investors would be asked to invest in unsuitable products. And for investors, the most important portfolio is the savings account. So a capital requirement regime which is sensitive to the capital is beneficial to the investors and the stability of the bank, because if capital requirements changes in accordance with the exposure risk, it's good for stability of the bank. There are two ways to do it: external rating agencies, and as you can see in films, I won't name names. Sometimes an external rating agency does this by some sort of guesswork. For example, there's a uranium mine in Russia, and the the transaction is securitized. I don't know how the external rating agency is going to rank this, to rate this, because the database would be very difficult to get. The calculation may be very different.
So my approach to this issue would be different from Mr. To. So sometimes when these credit agencies, when they approach their work, they don't really follow mainstream approaches. I'm not going to name names. Last year we saw some movies where when you tried to securitize a product, these were mortgage products, and isn't this exactly what we're trying to target? We're trying to target this type of behavior, and on the capital and liquidity return, you say that auditors will participate in this work, but in the bank's audit report, will they express their views on capital or the internal controls in their auditing report? Two big questions. Allow me to take the first question, and my colleagues can take up the second question. The Basel III regime regarding securitization framework that we're about to implement is targeting bank behavior. That is, how much capital they should set aside to meet the securitization transaction risk. So these rules they don't directly affect credit agency behavior. If you say that there's room for improvement in our design, I'm not sure if they will reflect on that, because this is not the ambit of our. This is not within our ambit. It's within the ambit of the SFC to regulate credit rating agencies. Now, regarding the process of auditing and financial information, whether it's accurate, if it's inaccurate, what type of action should be taken, I'll have my colleague Mr. Chu respond. Well, first of all, I'd like to talk a little bit about the credit agents, the external credit rating agency. We won't be using unheard of credit rating agencies. Within the Basel III, there is a framework where we have approved credit rating agencies. If they're recognized, then it will be specified in our banking capital amendment rules. We'll be using Fitch, Moody's, and so on. Mr. Ho also said that the regulating of these agencies is under the SFC. So when we accept these external credit rating agencies, there is a mechanism to do so. If they cannot comply with liquidity or capital requirements, just now our colleague said that every year the external auditors need to report, and we have to see if the financial reporting is accurate, whether their capital and liquidity requirements are in compliance. If there's any inaccuracies in the report, they have an exception report, and if necessary, our regulatory authorities can work with the external auditors, and they can have a tripartite meeting and discuss whether there were any problems in the reporting return. Any other questions? Well, I'd also like to ask members regarding these three subsidiary legislation, do we need to meet with the deputations? Okay, thank you. Next, we can conduct clause-by-clause scrutiny. Because I keep saying that this is very technical, so you should just tell us what we need to pay attention to. We don't want to waste too much time. So who can assist us? Thank you, Chairman. I'll attempt to paint a big picture. First of all, the first subsidiary legislation is the Banking Capital Amendment Rules 2017, and we have some amendments to the following areas. There are three major areas. The first one is to implement Basel III leverage framework, and through Clause 5 in the principal legislation, we have Part 1C, and we specify the minimum leverage ratio for AIs and the calculation criteria. And the second amendment is to implement the July 2016 the revised securitization framework, and the amendments including Clause 46 and 47. These will replace Part 7, the majority of Part 7, and the AIs in calculating the regulated liquidity level, how can they meet the revised securitization needs, and according to this how to calculate the requirements under the credit agency rating. And we also want to amend Part 8 so that even we have an interim capital treatment of expected loss provisions when we calculate this. We have to ensure that the regulated part is not changed. And the third major change is in order to meet the international accounting standards, we have made requirements to NSFR and CFR. So we will amend Clause 3A. The other amendments in Clause 3 and 4, 6 to 45, and 52 to 62 are the subsequential amendments or miscellaneous amendments. The second subsidiary legislation is the Banking Liquidity Amendment Rule. We refer that to BLAR, and these are liquidity amendments. The major amendments are Clause 5. In the principal legislation, we are at Part 3A, and it's to prescribe the minimum required level of NSFR and CFR to be maintained by different categories of AIs. And Clause 4 is Part 3A, and we require that the Commissioner can specify Category 2A, and Clause 12 is to add Part 9, and we have specify the calculation methods of NSFR and CFR. Clause 6 to 21 and 23 to 26 is a consequential amendment to the legislation. And lastly, in Banking Specification of Multilateral Development Bank Amendment Notice 2017, we have to specify the IDA as an MDB for the purpose of Section 22(19) of the Banking Ordinance. And we also, according to 2(19), the Commissioner can have we can define multilateral development banks, and regarding the capital and liquidity requirements, they can receive preferential treatment in interest transactions. So in our Clause 3 of the Banking Specification of Multilateral Development Bank, we specify the IDA as an MDB, and we also incorporate into the Chinese text the Chinese names of 7 MDBs. So the above are the three major amendments to the consequential amendments. Thank you, Ms. Zheng. It seems that if we don't have any particular objections or views, we'll assume that we have completed the scrutiny. But I think the legal advisor also has some opinion. So, legal advisor? Thank you, Chairman. There are two areas in the reading of the text, but it's not a major issue. If you look at page 1 of the marked up copy, they refer to clause 98A. This has been repealed, and it should be 97C. And I have communicated with the law draftsman, and they said that this is just shorthand, and it's not part of the law. So in the future, they can amend that through some editing. So DOJ, can they confirm that? Ms. Selina Lau? Yes, we have made reference to we have referred this to our colleagues, and they will update that information, and in our internet version we'll have the new information. So we don't need a CSA. It's not needed. The gazettal notice, we have quoted the correct numbering in 97C. The old information will be updated. Oh, second point, this is a typo in the marked up copy in page 189, clause 242, if the securitization are, but they have missed the letter S. So it's just a grammar typo, and I have already communicated with DOJ, and they will modify that at their earliest convenience. Ms. Lau, is that being remedied, and is that just a typo? We do need to handle that. We will change that as soon as possible, but fortunately this error does not affect the law. Well, the clause-by-clause scrutiny has been completed. We also heard from the government. So these three pieces of subsidiary legislation will take effect on 1st of January 2018. Now, according to our current timetable, the deadline should be 13th of December 2017. So I propose that on 1st of December we report to the House Committee, and the deadline for notification is 6th of December 2017. That's the timetable. So I will make an extension application in the House Committee, and in the Council meeting I will also report back. So if we don't have any other business, so members please take note. So before the expiry of the notification period, I will report back to the House Committee on our progress. AOB, well, if you don't have any other views, then I will apply for an extension, and our scrutiny work is done. Do we have anything else that you need to mention? If not, we have to thank the government, FSTB, Mr. Zheng, MA colleagues, DOJ colleagues, and let's hope we can cooperate again in other banking ordinances in the future. Thank you.